Are you feeling the squeeze, right? Quantitative tightening. We've talked about this months ago. And so I want to just kind of bring you an update. We're, wrapping up the week here this week, our team, and taking a look at all the stuff that we're working on, but just trying to also, communicate, update, and share with you what we see in the marketplace. So quantitative tightening, right? We talked about this months ago, probably in January, February, that the Fed has been non-renewing about $60 billion of treasuries per month for the last year and a half, meaning that provides a tightening, less money in the system because they're not renewing those bonds and other people have to purchase those bonds. And I shared with you a couple of months back that, the balance sheet on the Fed was, $9+ trillion. They've gotten it down to about 7.5. And I said that our expectation, our thought process would be by summertime, June, meaning that they would probably look to turn to cut that in half, meaning that they would actually go from 60 billion to 30 billion non-renewing, meaning that they would purchase back the 30 billion that expired. And so that's a good thing for the marketplace. And the reason why is that means there's less treasuries that have to be bought by the public. And then as a result of that, meaning less treasuries out there to be bought by them, that the price can go up because there's more demand for less treasuries, and then the yield goes down. So that's a good thing because, we've seen, good Lord, in the last, 5 weeks, the treasury has gone from, 385 to 465 almost. So an 80 basis point movement, which is not the friend for all of us. So that being said, we see in the March report of their minutes, the majority of the Fed governors are of the mindset that they could begin to taper down on the quantitative tightening program with an expectation of cutting it in half. So exactly what we said back in, January, February, and sent out to you guys is where they're at right now. Now, hopefully that will continue as a thought process and come together in their discussions at the May and or June meeting, and then be materialized with subsequent action. Now, the difference there is to the question of what real impact is it going to have on the marketplace. It's hard to say. Yes, it's a good and significant amount that they're going to be, purchasing back themselves, 30 billion. So that's great. However, there's a psychology factor in the marketplace as well. And that's what's really driven this, 80 basis point rise in the market. That, the market, as I shared again back in, probably March when the stock market was rallying and people were expecting, hey, great news, inflation's down and we're going to get a rate cut in March, or, 2 in the summer and, 1 in the fall. It's like, no, I think we're looking at more higher for longer is what we said. That being said, with the inflation and jobs data like we shared last week, running high, the psychology shifted gears, the expectation in the marketplace is interest rates were going to stay higher for longer. So we will see what happens. Now, again, based on economics and supply and demand, it should have an effect on at least tampering. Now, the other thing that we would want to hope for, and again, hope is not a great strategy. Yes, you need to have optimistic outlook and hope in your life personally. But from a business planning standpoint of view, hope is not what you want to hang your hat on. But what we would hope for is that there would be at least decent or non-growing numbers with respect to the jobs and or inflation data. And as I shared in the previous video, the government and administration is clearly not our friend. Virtually all their policies related to the green initiatives, to constriction of fossil fuels, to, funding infrastructure, to funding chip plants here in America, all of those things, all of them. I don't look, liberal, conservative, throw all that junk aside. All that stuff economically drives inflation. Whether you want to love the administration or not, that's the bottom line truth economically when you look at and understand functional economics, right? And so those things are not our friend, and they're contributing to this, unfortunate push that we've seen in inflation. And even too, like I said in the previous video, for God's sakes, the majority of jobs were produced for government jobs, healthcare and construction, all related to the policies of this administration. So again, not our best friend. So, but what that means is at least there's a positive and hopeful outlook that the Fed's going to do what we thought, start curtailing that, tightening economically on the balance sheet in terms of that. And so then as a result of that, we would hope to see some ease come in. Now, if we are able to see that coupled together with a positive psychology, meaning that there's a thought that rates are coming down, then we'll see a more money's moving into bonds, which will then move the 10-year down. So again, I want to just say one more thing. And again, we've talked about this before. Again, the Fed is moving on the overnight funds rate. That movement there does not directly move the 10-year Treasury. The 10-year Treasury, which drives 30-year mortgage rates, it drives long-term fixed financing for commercial properties with Fannie and Freddie, et cetera. That's driven by the market forces of supply and demand. And so that's where we need to see that psychology shift, people moving back into bonds. That demand will push price up and yield down, coupled together with the Fed easing on their quantitative tightening and buying that 30 billion of bonds. That will also help put pressure on price of the bonds and also push yield down. So that's what we're looking at. And so we'll keep our hands on it and keep you informed. And praise the Lord, you have a blessed and victorious week. For this is the week God has ordained for you.